Hello, 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 and welcome back to another edition of Milkshakes, Markets, and Madness. This is a show where we talk about the financial markets, we talk about the madness surrounding those financial markets, and we always do it through the lens of the dollar milkshake theory, which is a framework I came up with to help me kind of think about how the system actually works and what would happen if we were to get into a sovereign debt crisis. Anyway, thought it'd be kind of fun this week to kind of reflect on the week that was and look forward to the week that's coming, and then also give a little bit of a review of a report that we recently put out, and then I'm going to encourage you guys all to get and to read. But the week that was, I think the most interesting thing in the week that was obviously the presidential debate between Trump and Harris, and it was interesting for me because I did not watch the previous one with Trump and Biden. I saw some of the highlights, obviously, and that one was probably even more eventful because what it eventually led to, which was the somewhat resignation or the decision not to run by Biden. And so I decided I would watch this one with Harris and Trump. Part of it was because, I've met Kamala on a couple different occasions, or at least been places she was and interacted with her a little bit. And Trump is just always, you're always going to get a show when Trump gets in front of a camera. But of course, it was as maddening as everybody expected. I mean, you had Kamala, who hadn't given an interview in a month to anybody, come out and immediately not answer any questions per se, but you have to admit she was very well prepared and she had her practiced answers very well put together, and she delivered them very well. And I would say that she probably exceeded expectations. But there was times where you had her just, answering a question that wasn't asked. And then you had Trump talking about eating cats and dogs. And you had both of them just disgusted with each other. And, it ended about the way you would expect, somewhat of a disaster all around. But, I think in fairness, Harris probably did come out on top. But, there will be plenty of people on the Republican side who say the moderators were biased, and it would be hard for me to disagree with that. I think there was a number of leading questions. Oh, and the other interesting thing is I saw somebody put the entire transcript into Chat GPT or some AI engine and asked, if there was any examples of bias. And it kind of came out and it said that there was. Now, I'm sure you could probably run it through another one and say that there wasn't, but I just thought that was kind of interesting. In any case, the other things that were interesting last week, well, let me just pull up a couple slides before I get too far into this, because I put some notes together I wanted to go over. The big economic news heading into this week, which is the Fed meeting, was the CPI and the PPI numbers last week. And those were largely seen as going to determine whether or not the Fed was going to cut this coming week by either 25 basis points or 50 basis points. And it was really interesting because on Wednesday, the CPI came out and it met in line. And actually, one of the readings was a little bit stronger than expected. And markets sold off fairly hard in the morning, actually pretty hard in the morning. But by the end of the day, they had completely turned around and rallied back to the high, or to the highs of the day. And the best thing that I could find on it that led to this was Jensen Huang, who's the CEO of NVIDIA, kind of came out and said that demand was so off the charts that they couldn't meet all the supplies, and the customers were begging for more. And we've talked many times how passive indexes are driven by the biggest companies in the index, and NVIDIA is certainly one of those. And as NVIDIA rose throughout the day, then the markets kind of rose, and that's the only thing that I could kind of find that would have been a catalyst for the rise higher. Nothing else really jumped out at me. And then the next day, PPI came out and kind of met in line. And by the end of the week, equities were kind of near their highs. The dollar sold off. I think it closed just barely above 100, again, on expectations that rate cuts are coming. Gold had another great week, closed at another all-time high, 25.77, I think was the close. Silver shot back above 30 bucks, closed above 30. And but oil is still, I think oil closed around $67, $68, still below 70. It tried to rally at one point, but came back down. So we've got some interesting things. We've got interest rates going down. We've got equities going higher. We've got gold shooting through the roof, and we've got oil falling. So on the one hand, we've got deflationary signals. On the other hand, we've got inflationary signals. And we still don't know whether the Fed is going to cut, whether they're going to cut 25 or whether they're going to cut 50. Now, I think it's a pretty low probability that they don't cut, but whether or not they cut 25 or 50 is going to be kind of the question of the week. Now, I actually thought that we would have some we have had volatility this month. I thought we would see more downside going into the meeting and then probably rally out of it. But it looks like we have the possibility that we're going to go into the meeting kind of either at or very close to all-time highs. I still very much expect over the next 4 to 6 weeks leading into the election for there to be a lot of volatility, both to the upside and the downside. But I think we're going to go back down and test kind of those August low levels sometime between now and the election. I initially thought maybe it would happen before the Fed meeting, but again, with what happened last week, it looks like that has potentially been kicked out a little bit. But the other thing, the VIX is back down to like 16 or 17. And, for anybody who, has heard me talk about buying insurance, the best time to buy insurance is when you don't think you need it and when everything's at the all-time highs and when it's cheap. You don't want to be buying insurance on August 5th when the VIX is above 50. So I think the fact that it's back down around 16 or 17 is in many ways a gift. So again, I'm not telling everybody to go out and sell everything they own because the world is falling or the sky is falling. I just think it's a good time to be prepared because heading into the elections, I think it's going to be pretty nutty. But the other thing I wanted to talk about this week is I was interacting with somebody on Twitter, and or I saw this chart again, and I've seen this chart many times, and I retweeted it and said, this is the chart that will never die. And the reason I say that, and the first thing before I say that, this chart was put out by a friend of mine named Marin Katusa. And listen, he's a buddy of mine, and we talk, and we'll probably laugh about this. And it's not that I don't like the chart. The chart's a good chart, and I think it's a very important chart, and it's important to think that, most likely in the years ahead, commodity prices will go higher. But the reason that I tweeted it out, and said, this is the chart that won't die is because literally, and I'm not exaggerating on this, literally every January for the last 10 years, this chart has been rolled out as evidence that we are on the cusp or verge of an imminent commodity super cycle. And you better get on board the commodity super cycle because it is going to rocket higher and it's going to leave you in the dust. And if you don't get on the train right now, you're going to miss it. But here we are, 10 years later, and it's still at the all-time low. So the point is charts like this are very important to understand where you're at as far as positioning or as far as extreme either sentiment or, just as far as a price level. But it is not a trading signal. Just because things are extreme does not mean that it is an imminent turnaround. And I think there's no chart out there that demonstrates this better than this chart. Because if you look at it, it does make sense. You can't have a growing world and a growing economy with commodities always on the floor. And this is pretty clear that whenever there's a crisis, commodity prices oftentimes have been higher. Now, that doesn't mean they have to be, and I can explain some reasons why they wouldn't. But this chart does a pretty good job of showing that we're at a pretty extreme level. And it's more likely than not that 5 to 10 years from now, we'll probably be closer to those red dots than we are to the green dot at the bottom. But again, as the last 10 years have proved, it doesn't have to happen right away. And part of the reason that it hasn't happened right away is that despite the fact that everybody thinks that we're in this inflationary environment, and I'm not saying that we're not, but there's a lot of people who think that there is no way that we can have deflation. But we can have deflation. And in a debt-based monetary system, there is always the risk of deflation. In fact, it's the risk of deflation that causes the central banks to quote unquote print. Okay. And we've talked about this many times, and I hope that I'm starting to get through to people that when you loan money into existence, that loan or that activity of loans has to keep getting bigger and bigger and bigger and bigger. If it ever stops growing, then you get a credit contraction and it goes the other way. And because it's loaned into existence, when those loans start defaulting, you not only get a reversal, you can get a crash back the other way. And that is why in a debt-based monetary system, there's always the fear of deflation. China is dealing with a ton of deflation right now. Now, the fact that they have a weak currency and they have to import important commodities such as energy and food and some other needed inputs that they can't produce locally, they do have inflationary pressures from that aspect. But internally in their economy, they're dealing with a ton of deflation due to all the bad real estate loans. And because China is often seen as the growth engine of the world, if their economy is slowing and not growing, then they're not consuming as many commodities to make everything that the rest of the world provides. And that's part of the reason that we haven't seen a bull market in commodities. China is a big part of that. The other reason is that the majority of the growth in the world over the last 2, 3, 4 years has come from the United States, but it's mostly been in the stock market, and it's mostly been in the tech sector, where it's an expansion of valuations as opposed to dramatically increased earnings or dramatic growth story just from an economic output standpoint. And if it wasn't for the U.S.'s growth over the last couple of years, there wouldn't be that much in the world. Now, I know there are some emerging markets that have done okay over the last year or so, but by and large, all you have to do is look at the outperformance of the United States stock market versus the rest of the world, and you can see that most of it is coming from the United States. The other thing is that a lot of people will say, we don't even have that good of an economy. Just because the stock market's up doesn't mean that the economy is doing great. Case in point, that's another reason why this chart is where it is because the stock market has held up, but the overall economy hasn't. And if the overall economy is not growing, it's going to be very hard for commodities to do well. So I don't know. I hope whoever I was interacting with, I hope that kind of helps explain this chart a little bit. But this kind of leads into the next topic that I want to talk about, because we're talking about, even though we're in an inflationary environment, and even though we have seen the U.S. raise interest rates dramatically over the last couple of years due to inflationary pressures, they are now getting ready to cut rates because they see potential. They see the slowing of inflation and potential deflationary pressures coming. That is what's leading to potential rate cuts. And that leads into, let me just, sorry, I kind of lost my train of thought there. Oh, it jumps into, I wanted to talk about the carry trades. So we put out a very big report on carry trades. This is on the Macro Alchemist. I think many of you probably follow the Macro Alchemist now. If you go to macroalchemist.com, you can put your information in. You can get this report. You can get all the past reports as well. But this is a different channel that we use to put out research that a friend of mine and I do. And we've put out several reports now, but we just put a big one out on carry trades. And the reason that I was talking about deflation leading into this is because carry trades have a lot to do with deflation and inflation. And a carry trade is often put on when somebody finds low interest rates in one place, and low interest rates are often indicative of deflation. And then they'll go invest somewhere that has higher interest rates. And that's typically, not always, but indicative of inflationary pressures. And that's what a carry trade is. So that's kind of the intro here. But the other reason that this is important is because there was about 6 weeks ago, we had a big, when all the volatility happened at the end of July and beginning of August, a lot of it was attributed to the yen carry trade. And you may have heard of this yen carry trade before. But I think there's probably a lot of people who don't really know what a carry trade is. So we put the report together to kind of explain what is a carry trade? And so what we did is we went through and we kind of explained what a carry trade actually is. We talk about we end up focusing on Japan. So we do a lot of background on Japan to explain why the yen carry trade even developed. We go through a number of historical examples of carry trades, and then we also walk through a number of bad things that happen as a result of carry trades. And that's the thing, is carry trades always blow up eventually. It's just a matter of when. But if we jump forward here a little bit here, the big point that I want to get out of this, if you don't take anything else away from the report, or if you don't even read the report and you're just listening to this podcast, and you want to get the main message is that even though fiat currency get debased over time, relative levels of fiat does matter. I think over the last couple of years, as inflationary pressures have been higher than they have in the recent past, more and more people have kind of become aware of the fact that all fiat currency loses value. And as a result, all you have to do is go buy hard assets, because it gets inflated. Fiat currency gets inflated away, and the hard assets will rise in price as the currency loses value. But look, all we have to do is go back to this chart here to know that you could have started taking that advice 5, 6, 7, 8, 9, 10 years ago, taking that advice because fiat currency loses value, and yet 10 years on, you still haven't made any money. Now, I know there's somebody out there saying, yeah, but gold has doubled. You're right, gold has doubled, and you should absolutely own gold. Everybody should own gold. But my point is that as the idea that just because fiat currency loses value over time, that you could just go out and buy hard assets, something other than gold, and it's automatically going to make money. It doesn't necessarily work like that. So let's go back up here. And not only that, the reason that fiat versus fiat does matter is because fiat versus fiat is what causes crises. That is what leads to really bad things in the markets. And I'm going to go through and I'm going to explain this in a little bit more detail. But essentially, the reason that this has even come to the fore is because of the yen carry trade that quote unquote blew up 6 months ago. But essentially what happened with the yen, and the thing is, this goes back 20, 30 years. So you're going to have to understand there's a little bit of a history involved here. And the other thing is that the yen carry trade has grown and blown up 3 or 4 times. So this is not the first time that this happens, which is, again, it's further proof that people don't learn from history. They just keep repeating it over and over. But essentially, after the great growth story that Japan had in the late 70s and the 80s, even into the early 90s, they had a big, the bubble burst, and then they had massive economic stagnation and deflation. And it lasted for decades. And the strategy that the Bank of Japan employed to fight this was extraordinary monetary policy that, for the most part, would keep interest rates very low. And the idea is that you keep interest rates very low, and that will then engender growth, or it will encourage growth. It'll encourage people to borrow and then go invest. Well, it certainly did that, but it wasn't just people in Japan borrowing. What happened was the rest of the world started buying or started borrowing in yen, and then you go invest it elsewhere. And the reason you borrow in yen is because it's very cheap. And the reason it's very cheap is because they held their interest rates low and do these really, extraordinary monetary policies. So, but let's start off with what a carry trade actually is. And listen, I've taken these notes here. These come directly from the report. So if you download the report, you're going to have all of this. And what I would recommend is, read the report, but then just keep the report. And anytime, the carry trade topic comes up, or you want to dig into it, it's almost like a reference. You can go back and you can give yourself a little tutorial on it. But really, it's important to understand the mechanics of a carry trade. And it's really not that complicated. I think a lot of times Wall Street will make things sound more complicated than it actually is. But essentially, a carry trade is a leverage trade where you borrow at a low rate, and then you take that money and you try to go invest somewhere that's yielding a higher return than what you borrow at. And then whatever the difference is, if you're borrowing at 1% and you're making 4%, well, then 3% is the carry. So that's where the carry trade name comes from, right? And so I mean, that's essentially, now there's lots of different ways to do it, but that's essentially what a carry trade is borrowing in one place, investing in another, and hoping to make the spread. But there's many different ways that you can actually employ this. There's not just one way, but the typical ways that the currency carry trade is often the most popular. So as an example, you short the yen or you borrow in yen because the interest rates are at zero, and then you turn around and you just buy T-bills, right? You're borrowing yen at I don't know, 25 basis points or 0.5% or whatever it is, and you turn around and you just buy T-bills and you make 4%. That's not too bad, right? And as long as the currency stays steady, well, then you're making money. The other thing is you can do a commodity carry trade. So a good example that would have worked fantastic here is if you would have borrowed in yen, because again, you borrow in the US, it's more expensive. But if you borrow in yen and go buy gold as an example, right, or some other commodity that has gone up a lot, that's a heck of a carry trade, right? Because you're borrowing, your cost of borrow is zero, and you go buy the commodity and it goes up, and all is great. The other thing is you could just do a very simple fixed income carry trade. This is where you borrow in yen. Like I said, you go buy T-bills or you go buy Brazilian bonds or something that are yielding more than they're yielding in Japan, and you make that carry. And then the other thing is you could short the yen, or you could borrow in yen. You go buy the Nasdaq, you go buy Nvidia, you go buy Apple, and as long as it's going up more than your cost of borrow. And and the reason you would do it in yen rather than just doing it in the US is because the cost of borrowing in the yen is lower. And so and because Japan was fighting these deflationary pressures for literally, 20 or 30 years, the yen was always, or almost always, the cheapest currency to borrow in or the cheapest currency to short. And as a result, that's what led to, over these years, these big buildups of these investments around the world, is because people would borrow in yen and they would go invest it in Brazil. They'd go invest it in Iceland. They'd invest it in Europe. They'd invest it in the Nasdaq. They'd go buy Australian real estate with it. And so again, many times throughout history, this has built up, and then as something blew up, it reversed, and the yen carry trade would blow up, and money would flow back into Japan as that leverage got deleveraged, and then it would build up again. And that's kind of what happened 6 months ago or 6 weeks ago. Was it had built up over the last couple of years because the yen had fallen a lot and because interest rates were very low. But then with Japan starting to raise rates, people got scared. The yen started to strengthen. They were afraid that their borrowing cost was going to go up a lot, and so they would unwind that. And unfortunately, they're unwinding that at the same time that all the asset prices is falling. But we're going to get into the yen a little bit more. But before we get to that, these aren't without risk. And the fact is the reason people put carry trades on is because they are so alluring. They look so great. And it's you borrow at zero and you invest in something safe that's yielding 4%, and you get basically getting 4% risk free or something like that, right? And you lever it up once or twice, maybe 3 times, and now all of a sudden you got a 10% return, for investing in something very safe. Well, the problem though is that it's never that simple, and it's never that easy. And there's many risks that go along with this. And they go, interest rate risk is one, the currency risk is another. The political risk influences both interest rate risk and currency risk. And so that can have a huge ramifications. And I'll show you an example of that. Liquidity risk is another one. Is when these carry trades blow up, but they typically blow up when there's not much liquidity. So if you're invested in something that isn't very liquid, and all of a sudden it's dropping in value, and your cost of borrow is going up, and the value of the asset that you bought is going down, but you can't sell the asset that you bought because there's no liquidity, that's a good way to lose a lot of money. And then leverage. Anytime you use leverage, risk is going to be enhanced. So there's numbers of ways that these carry trades can go wrong, but this is a good example of the different ways that they can go wrong. Now, some historical carry trades that kind of became famous. They didn't become famous for entering into the trade, they became famous because they blew up, right? And that's, unfortunately, this is the way carry trades often end up. But the ones that we decided to focus on, and listen, there's many of these, but we focused on these because they were all very similar, but they all had their own little spin on it. Was the Mexican tequila crisis? Now, this isn't actually a crisis involving tequila. That would be interesting, but that's not what this is. It was just, they named it the tequila crisis because it happened in Mexico. There was a Swiss franc carry trade that went bad a couple of years ago. There's a Westpac bank down in New Zealand and Australia that had a big blow up that I'll tell you about. The Thai baht led to the Asian currency crisis, which people probably have heard of. And then we'll talk a little bit more about the yen carry trade that we just mentioned a minute ago as well. But essentially what happened in Mexico was, if you remember back in the early 90s, the U.S. was kind of in a recession. We were starting to come out of it a little bit, but growth was pretty slow, and investors around the world were looking for other places to put their money. Where can we get growth? Because growth in the developed markets is just not there. And emerging markets were starting to get a little bit better reviews and more popular. And so people started looking for places to invest. And Mexico was growing pretty well and doing pretty well. The problem was that Mexico was getting a lot of their financing. Their government was getting a lot of their financing to finance the growth in the economy. They were getting it from outside Mexico. So they were getting it from foreign sources. But for foreign sources to go invest in an emerging market, when you're investing in the US, or if you're investing in kind of a Western developed market, you don't have as many risks as if you're going to an emerging market. Once you go outside your country, now you've got political risk that you don't have in your, or at least maybe not the same political risk that you have in your own country. And you don't have currency risk. If you're investing in your own country, you don't have currency risk. But as soon as you step outside your borders, now you've got currency risk. And so, of course, the bankers who were trying to raise money for Mexico, they want to overcome the objections of somebody who wants to invest in Mexico. And so what they did is they said, well, Mexico, why don't you just issue these short-term bonds? Your economy's doing great, but just denominate them in dollars or make the interest payments payable in dollars. And that way, that will eliminate the currency risk. That will make it much easier for these investors in, Europe and the United States and some of these bigger, richer economies to invest in your bonds. And so they started issuing these short-term bonds that were basically, for an easy way of saying it, payable in dollars. And this all went great until the economy started to slow. People started to get a little nervous, and then a leading politician was assassinated in Mexico. So now you have political risk jumping through the roof, a lot of uncertainty. The money isn't flowing in as well as it was before. So now the peso starts to lose value against the dollar. And then as like I said, when the guy was assassinated, that led to even more uncertainty. And as they had to raise more money to kind of not only pay the short-term borrowing that already existed, but to continue funding going forward, they just didn't have the capital to do it. And as they didn't have the capital to do it, then the exchange rate with the dollar spread out even more. And it got to be where they just couldn't make the payments anymore. And so you had a big bailout. The IMF had to come in and bail them out. And the US I think the Fed had to bail out some of the US banks that were involved in it. So this is an example of where, if your revenues are in one currency and your liabilities are in another, it can go bad pretty quickly. When it works great, and everybody, it's like anything. When it's going great, nobody asks questions. Everybody just puts their foot down on the pedal and goes. It's only when it starts to blow up that people say, well, wait, how does this work again? And that's, this is an example of a historical carry trade that went very, very badly. The other one was, it was probably about, 10 years ago, 8, 9, 10 years ago. I think it was 2015. Basically, Switzerland has a very strong currency because there's a lot of external demand for the Swiss franc. And so they didn't want the Swiss franc to be too strong because that would hurt their local economy, and it would hurt their ability to export because their currency was so strong. If your currency is strong, it's harder for other countries to buy your goods because they're more expensive. And so what Switzerland did was they pegged the Swiss franc to the euro because that's their region that they operate in is Europe. They wanted to be on the equal footing with their European counterparts and trade partners. And so they pegged the Swiss franc to the euro, and they said that they were going to keep doing it. And this led to them getting an enormous amount of foreign currency reserves as they came in, but it was costing them more and more and more to keep this peg in place. And so even though they had said they were going to continue doing it, at one point they decided that it was just going to be too expensive to keep doing it, and so they let it go. And that's what you see here on this chart. You can see it was getting weaker and weaker and weaker, and then all of a sudden it just shot up, and it literally appreciated like 20% in a couple hours or something. I remember I was living in San Francisco at the time, and I remember my phone beeped in the middle of the night, like 3 a.m. So it would have been 9 or 10 a.m. in Switzerland. And I look at my phone, and all of it's a friend of mine, and all it said was "wow." That's all it said. And so I'm like, "Oh my God, what happened?" So I get up and I go and I look, and sure enough, that's when I think his name was Jordan, the central banker from Switzerland, had announced that they had let the peg go. And listen, this caught so many people off guard because they were short, they were borrowing in Swiss francs because it was guaranteed by the Swiss central bank that it wasn't going to move. And because interest rates were basically at zero in Switzerland and the currency was pegged, there was, again, quote unquote, no risk, right? You can borrow in a currency that's guaranteed not to move, and there's zero borrowing cost. And well, what happened though was when it moved 20% in a couple hours, you can imagine how many people got blown up, and hedge funds went out of business and exchanges went out of business, and it was a big disaster. And if the crazy thing about it became such a big disaster that Switzerland basically had to re-implement it. They didn't re-implement the peg, but they did drop interest rates to not only zero, but negative. And that's why you can see in this chart, it shot up and then it got weaker again over the next 6 months or next 3 months because it was too extreme that it went the other way. So the people that got blown up in that 2 or 3 months, if they would have had a way to stay, quote unquote, in business for 2 or 3 months, they would have been totally fine. The problem is these are leveraged trades. And when they go against you, and when they go against you that big, you just get stopped out and you get blown up and you don't live to see another day. So that's another example of a carry trade that went wrong. This one, I think, is one of the most interesting. Now, this took place back in the 80s. It took place in Australia and New Zealand. There's a bank down there called Westpac. And at the time in Australia and New Zealand, interest rates were fairly high. I want to say they were, I don't know, 13, 14, 15, 16%. And so if you were taking out a loan to, build your business or buy some property, and there was a lot of farmers involved in this, and, ranchers that were trying to expand their operations, got involved in this because this bank came up with this great idea, because the Swiss franc and the Australian dollar exchange rate was very steady. And Switzerland, because it was such a steady economy, they had very low interest rates. Interest rates in Switzerland were around 5%, which was about 66% lower than they were in Australia and New Zealand. So they came up with this great idea. Why don't you take out your loans in Swiss francs, and you'll only have to pay 5% interest rates rather than 15% interest rates? Sounds fantastic, right? Of course, sounds great. And when your neighbor does it, and when your competitor does it, and you say, wow, how are you only paying 5% for your loan? And they say, well, we bought these Swiss franc loans. And that sounds pretty good. So then you go do it. And then pretty soon everybody's doing it. And that's great right up until the Swiss franc. Oh, I didn't put it on here. Sorry, I should have put it on here. Basically, the Swiss franc, Switzerland, the Swiss franc strengthened dramatically versus the Australian dollar because the Australian economy started to slow down a little bit. The Swiss economy stayed strong, and over like a 6 month or a year period, the Swiss franc doubled in value versus the Australian dollar. So anybody that had taken out these loans, now they owe, if you took out $1 million, I don't think it doubled. Maybe it went up 30 or 40%. But if you took out, let's say you took out $1 million loan to build a factory. Well, even though you were making your interest payments, now you owe $1.4 million. So you can see how this would not be good, right? And it had such a huge impact on the overall economy that there was all kinds of, it was a huge scandal. And the regulators got involved, people went bankrupt, farms went bankrupt, and then you had the people that didn't lose money coming in and buying the farms, and so then you had an inequality issue, and it was the evil bankers, we need to throw them out, and again, you can read the paper to get more detail, and you can look it up on your own. But again, this is a case where when everything's going good, it sounds like a fantastic idea. The problem is if your liabilities are denominated in a currency that you don't earn money in, and it goes against you really bad. And then finally, the last one I'll talk about is the Thai baht. And the Thai baht, this is what led to the Asian currency crisis in the late 90s. Now, again, if you remember, like I said earlier, when we were talking about Mexico, in the early 90s, the developed markets were kind of in a recession. There wasn't a lot of growth. And so people were looking around the world for where there could be better growth. And in the mid 90s and mid to late 90s, the story at the time was the Asian tigers. These China was a rising power, and all of these countries surrounding China were benefiting from the growth of Asia. And these Asian tigers were growing at much faster rates than the developed economies. And this was a great way to boost your portfolio returns or make more money, whatever you want to call it. And you can see on this chart, this is the Thai baht to the US dollar. For about 4 years, it was just a flat line. Well, one thing you need to know is if you ever go out for a walk, there are no straight lines in nature, right? And there's no straight lines in financial markets either, unless they're being manipulated. So that's what you see here. This is a currency peg. The way that Thailand attracted this money that was looking to invest in the Asian tigers was they decided they pegged their currency to the dollar. And so that's why it's flat like that. But when you peg the currency to the dollar, why do you do that? You do that so that the people that are coming in to invest don't have to worry about currency risk. You eliminate that risk for them. It makes it easier for them to make that decision. And then the money comes flowing in. And that's exactly what happened. And the money flowed in, and the Thai economy was going great, all up until it wasn't. And then when growth slowed and the money stopped coming in and they couldn't maintain the peg broke. And you can see how far it went. The Thai baht went from 25 to 55 in a heartbeat. And of course, it was so bad that then it started affecting other currencies. And it wasn't long before you had a full-scale currency crisis all throughout Asia. And again, it all goes back to, thinking that you're investing in a currency that has no risk when in fact there's incredible risk. And so again, this is just another carry trade going wrong, but you can read more about it in the report, or kind of do some of your own research if you're interested in it. But the last one I'm going to come back to, and I'm talk a little bit more about Japan again. And I won't make this too long, but essentially the reason that the yen carry trade got so big, again, was because they were in this economic stagnation for so long. And the way that the Bank of Japan decided to fight it was to keep interest rates really low. So if you see on the left, this is a chart of Japanese interest rates. Now, this is the 10-year, but you can see it kind of hugged, that between 1% and 0 for, a decade. But the equivalent to their federal funds rate, it's even lower than this. And then because interest rates are slow, and because so many people are shorting it, are shorting the yen, and then because the Bank of Japan is buying so many bonds in order to keep interest rates low, that's making the yen weak. And so on the right, you can see the yen falling. Now, this is futures. This isn't the exchange rate. This is the futures. But I did it this way because it makes a little bit more sense. You can see it's fallen like 40% in the last 3 or 4 years. Now you can see that little uptick on the yen in the last month or two. That is as a result of the Bank of Japan raising interest rates from basically zero to I think 15 or 20 basis points. And so, just that small little move in interest rates caused the currency to go up because everybody's worried now. Are they going to be able to, are they going to take interest rates of 1% or 2%? But here's the problem that Japan has. The problem that Japan has is if they take interest rates back to 1 or 2%, all of these bonds that were issued at interest rates that you see on the left are now going to be underwater. Remember, they had zero or negative rates for years, and they were issuing Japanese government bonds. And all the banks and the brokerages and the insurance companies and the endowments and the pension funds, they bought all the JGBs, or the ones that the Bank of Japan didn't buy. So the problem now is if Japan lets the interest rates go higher, then all of those bonds are going to be underwater. And pretty soon, it won't be long before you have a banking system problem, you'll have a pension problem, you'll basically have a crisis in the Japanese economy. And so they're really damned if they do and damned if they don't. And so it's going to be really interesting to see. And now everybody now thinks that the Japanese yen is going to strengthen dramatically because now the Bank of Japan is going to get serious about raising interest rates and saving the currency. I don't think it's quite so certain, but when there's that much leverage involved, things can happen quickly. So I'm not going to sit here and say that you couldn't have the yen rally significantly. And to that point, people will say, well, Brent, you're the one that keeps saying that the yen's going to go to 200 or 300 because they can't let interest rates go higher. And listen, I'm standing by that in the medium to long term. My point is in the very short term, you could see the yen strengthen as all of this leverage gets unwound. But I think once that happens, then you're going to see it go back down. And the other thing I would say is that if the yen rallies significantly, that's typically a risk-off scenario. So the worst of all worlds is when the yen rallies along with the dollar. So think of the yen and the dollar as two currencies and then all the other currencies. When the yen and the dollar are rising versus all the other currencies, that is typically very bad. And I'll give you two examples. This is the Japanese yen and the US dollar versus each of them versus the euro and the British pound in 2000 leading into the dot-com boom. So you can see the fact that the dollar, you can see right here, the dollar and the yen are both rising against the euro and the yen. That was a very big risk. And I couldn't do it for all the currencies, but it looks similar for all the currencies. That was a huge risk-off time period during the dot-com crisis. It was a liquidity crisis. And in a liquidity crisis, the big leverage gets unwound. And the big leverage is in the US dollar and the Japanese yen. All you got to do is go back to 2008 and look again. Same thing. The yen and the dollar rallying together versus the other currencies. And that is a huge risk-off event. And so, if we get into a situation, where the yen is rallying and the dollar isn't rallying because the yen is, that's not necessarily a good thing. In fact, that could be a really bad thing as far as liquidity and therefore a really bad thing for the markets. I think there's just one thing left that I'm just going to go and just reiterate this one point, because this is probably the biggest thing that I get thrown at me when I talk about the dollar. And the reason I say the dollar is so important, and people say, well, Brent, the dollar isn't that important. They're all getting debased. That is true. Fiat currency loses value over time, but it doesn't always happen in a straight line. And when leverage is involved and when carry trades are involved, you can get big swings in currencies. And big swings in currencies are a nightmare for capital markets. And so unless you have all of your money in gold and you have the ability to ride it out, and you don't care what happens to your business, and you don't care what happens to your house, and you don't care what happens to your job, then fiat versus fiat does matter. And so it's really important to understand these dynamics as we kind of go forward in the years ahead, because I think despite the fact that people are becoming aware that fiat currency loses value, which is a great thing, it's very important to understand that fiat currency loses value over time. But I think it's going to be equally important to understand that fiat versus fiat is very important. And even if you think it doesn't matter, it can end up causing you tons of pain. So I'm just going to leave it at that. We got a big week coming up, so looking forward to seeing what happens there. And we'll see you guys next week. Have a good one. Bye.